Hello and welcome to videos regarding depreciation calculation. So today I'm going to be doing 3 short videos that are going to show you how to calculate depreciation. Depreciation, as you know, is the way that we do in accounting to expense an asset, particularly a fixed asset, property, plant, and equipment, slowly over time, to adhere to GAAP's matching principle, where we want to match the expenses with the revenue they generate. And we know that fixed assets, generate revenue long after they've been purchased. And so we have come up with this depreciation methods to match it to the best of our abilities. And there are 3 depreciation methods. And this first video we'll be dealing with the first method, which is straight line depreciation. So straight line depreciation formula is cost minus what we call salvage value, or sometimes the word residual value is earned interchangeably. And the salvage value is our estimated value of the asset when we're done using it, or we've used it up based on its useful life. It's that market value that we hope to get when we go and sell it. But we know that's only an estimate. We know market values can be very persnickety, in the fact that, you can find a 1955 Corvette in a hole in a barn and it costs $5,000, and when you take it out, it's already worth $20,000. So we don't know what it's going to be. This is our best estimate of what the value will be of this asset when we're done using it or at the end of its useful life. And when we talk about useful life, that is the last piece of the calculation, which is the useful life. And that is our estimate, once again, of what we believe the asset will be able to generate revenue for us. It is sometimes it's based on categories of certain types of equipment. It can be based on your specific industry. The IRS has its own table for depreciation, and we call that MAKERS. Okay, and some companies, when they're small, will just use their depreciation schedule that the IRS uses because it's easier. Other companies will go ahead and have multiple means of depreciation. And so it all depends on your particular company. But when we're talking about straight line depreciation, we're going to take the formula of cost minus salvage value equals useful life. And so if you look at page 207, and we're going to look at exercise number 3, and that's the one that I will be doing an example for. And in this particular problem, they tell us that the cost is $18,000. The salvage value is $4,000, and the useful life is 7 years. When we do the math, we end up with $2,000. So this will be $2,000 per year of depreciation. If you were to book that based on what you know about adjusting entries, you would go ahead and debit depreciation expense for $2,000, and you're going to credit accumulated depreciation. Up to this point, the book just gave you the $2,000. Now you can compute the $2,000. Also note that this is going to be done $2,000 per year for 7 years. So at the end, you will have depreciated $14,000. Note that the full cost is $18,000, right? So 18 minus 14 equals that salvage value. You can never go below the salvage value when depreciating. And so once you're done depreciating for 7 years, you will have a value based on your books of $4,000. And you get that by taking the asset, which is $18,000, less the accumulated depreciation, and I'm abbreviating, of 14, gives us something we call our net book value, will be $4,000 after the end of 7 years, which then equates to our salvage value. And that is straight line depreciation.